Yes. Okay, thanks everyone, and sorry about the delay on getting the presentation up. I am going to talk more generally about recovery in housing markets. So it'll be not just HMDA data, because we are doing a number of things that I think that are helpful, but I will definitely talk about some recent HMDA data, because we did just do the processing on 2016 data. Just so it's clear to everyone, I want to keep my job, so the views expressed today are in fact my own and not necessarily those of the Federal Reserve Bank of Cleveland. So let's talk a little bit about the housing recovery nationally and also in the 4th District. And just to define terms, I mean, I am from the Federal Reserve Bank of Cleveland. Our district is all of Ohio, eastern Kentucky, western Pennsylvania, and the panhandle of West Virginia. So I will show a couple things that are being drawn from that area. So just to set things, you know, to sort of make it clear, sort of what are we thinking about when we think about housing recovery. I want to show the sort of longer run picture of 2 series, new single-family homes, that's in blue, and existing single-family homes. And of course, the recession bars are quite evident. And the really long one over there is, of course, something often called the Great Recession. You can see right away that housing is a very important part of what changed in the Great Recession. So, you know, we're often thinking about that as being very housing driven. If you look at the new home sales, you can see just sort of how much it had risen. It's interesting to see, yes, the slope of that's a lot steeper than it was in the prior recovery. But, you know, that peak is something that we're not even close to today. So from a macroeconomic perspective, that's a lot of, you know, sort of how we think about the housing crisis. Now I'm going to get down to some actual, very much in the weeds Cleveland neighborhoods too. So that's definitely part of the housing crisis as well. But I think when you're thinking about it in terms of data, this is one way to start. Another thing that we, of course, experienced was that home prices responded in the Great Recession. So here I'm looking at district home prices versus nationally. So nationally, you would have seen, you know, periods of time where you're seeing 7% reductions year over year in home prices, and that, of course, pulls down home prices quite a lot over time. We have seen home prices recovering, but, you know, again, that's not necessarily a recovery in housing markets. What about debt? So one of the things that we came out of the financial crisis doing is looking a lot more carefully in a lot of detail in households' debt levels that we couldn't have done sort of pre-crisis. So I'm going to start with a chart that we could have done pre-crisis, and that shows you sort of what's the total debt burden of households. So it's just collecting up the dollars in the different categories, and right away you can see that far and away the largest category of debt and the largest category of where households you know, are drawing on banks is the orange bars. So it is the mortgage credit. You can see that green bars, which you know, turn out to be pretty important during the crisis as well, are home equity lines of credit. So, so there are two categories here that are substantially you know, home based. And then I'd like to point out another category that that has been very important. So if you look over on the left-hand side, you're looking at the little red categories. Those are student loans. Student loans are pretty small over there. The one category of debt that has been growing pretty substantially is student loans, and so, you know, not surprisingly, that's received a lot of attention. But today we're going to mostly focus on home, you know, home as the source of equity. So while the debt levels have actually been rising again, and I think, you know, it is important to see that there was a turning point after a lot of debt reductions. U.S. households have gradually expanded their indebtedness. Wrong direction. But when we think about sort of how much of a burden is that, I like to, you know, express that as, you know, a debt service ratio. So of the two here, I'm fond of the darker red one, the debt service ratio. And what it's asking is what fraction of the income level has to go towards making debt payments. Now, this number is calculated by the Board of Governors. It's done, on a totally macro basis. So we just sort of look to see sort of how much debt is out there, what's the interest payment, what's the schedule, and then figure out, what level of debt payments households are making. And I think, one of the things that we've seen throughout this recovery is that households are, considerably less burdened by their debt. So if I'm looking over on the far right here, I'll see that, households' debt service level is now 10%. If I actually go back to the start of the series, at the start of the series, debt service by households was about 10% as well. So despite the really large increase in indebtedness over this time, the fact that interest rates are so much lower, that incomes have gradually risen, means that households' debt levels are actually, at really pretty low levels at this point. And what we can do sort of post-crisis using data that comes from Equifax and the New York Credit Panel is we can now look at MSA debt service as well. So we can now contemplate what fraction of a Cleveland household, thinking about this as the metro area, what fraction of their income is going into different forms of debt. And here again, you can see that mortgages are still the largest category, but the levels of mortgage debt are lower than you're going to see nationally. And we'll take a look at that a little more carefully. Auto loans turn out to look a little larger in this space, so Cleveland borrowers seem to like their car. Although having looked at most of the U.S. this way, one of the interesting conclusions about auto loans is Texans really like their cars. So they put a lot of their debt service into autos. So what about thinking about mortgage debt service in Cleveland, MSA, and Ohio? So, again, the pattern is a lot lower than the nation. So the nation is that lighter line that's up at the top. It peaks at over 7.5%. Ohio, in the darker blue color, it's always a bit lower. Cleveland starts out a little higher in debt service than Ohio, but by the end, we're actually at pretty typical to Ohio levels. And the overall, looking across all people in the metro area, and thinking about how much of payments are being made, throughout the metro area versus the metro area's income level, we're now actually below 5% for debt service. So the household's indebtedness is not, a significant, large factor in sort of, holding back aggregate households, and that is, of course, not every household. This is the average household. But, one of the things we can do now is look sort of within the metro area. So I do want to focus kind of a fair amount of attention on Cuyahoga County and Cuyahoga County neighborhoods. My colleagues at the Federal Reserve Bank, helped produce a publication earlier this year, and it looked at 2015 data. So I encourage you to look at it. It's got lots of text and better descriptions than I'm going to give you of all of the trends today. But I think, one of the things that we can do is we can really look at neighborhoods, and we can look at what's been happening sort of within the county. But let's start right away by sort of asking some of those questions about sort of what is happening on loan applications, on actual originations across time, just to sort of provide some perspective on that first. So when you look at applications and originations, you can see that prior to the housing bust, there was a fair amount of activity here. That actually pushed down a little bit what I'm going to call the origination rate. So that's the given an application, what fraction of applications are actually approved. I'm going to call that the origination rate, and we're going to look at that a couple times. So, both in applications and originations, there was a peak there pre-housing crisis. If you're looking over on the right-hand side, you can see that both applications and originations are, on the low side, really back to 1990 levels at this point. But, there's a lot of lending activity that is showing up both to actually purchase a home, but also to refinance a home. And so a lot of what we saw is that spike that was in that sort of early 2000s period turns out to be a phenomenon where it's primarily about refinancing. That the extra originations were not about, more home purchases. I mean, home purchasing's kind of going along. And it was going along at a level of about 20,000 here, through most of the 2000 period. Now, the fact is that, after that period of time, and if we're looking at the last decade, you're going to see that, we have considerably lower home purchases during this time. We have considerably lower refinancing. And we want to see, that both of those patterns show you that today's housing market is still not the same as pre-recession. And, a lot of people will correctly say, I don't need another housing boom. I don't want another housing bust. But we're definitely still not seeing sort of patterns that are similar to the 1990s. We're not seeing patterns that are similar to the 2000s. We're seeing a definitely lower level of activity in housing levels and in housing lending. What about the neighborhoods? I want to think about different income levels. So this is a map of census tracts by 2015 income, and they're roughly designed to be, so we've got our low and moderate income census tracts. They represent a little more than half of the census tracts in the metro area. One of the unfortunate things is, there's always some data challenge, is that the census tract definitions, of course, change after censuses. So I'm actually going to have to show you a couple, I'm going to show some charts that actually we had to think about, well, how are we going to do this given that the census tracts changed? We're just going to show you this map. But, the sort of general pattern of this map is going to be pretty clear to people. I've got the dark black boundary is the boundary of the city of Cleveland. The census tracts that are inside that boundary are more frequently low or moderate income tracts, but there are many suburban areas of Cuyahoga County that have at least moderate income tracts in them. When we look at loan applications, we want to think about whether there's been a recovery in housing. One of the things I want to ask right away is, well, sort of how well is that distributed across low, medium, low, moderate, middle, and high income neighborhoods? And here I'm showing you those, again, loan applications, but I'm showing it, cut into high, middle, and low. And right away you can see that the sort of purple line, and I hope you can see, the purple line, which is going to be the top on the right-hand side, actually is the only one that's kind of vaguely similar to the levels that we're seeing sort of pre-recession. So it's down a little bit from pre-recession periods, the purple line, and that's the high-income neighborhoods. But even middle or moderate income, all of those categories are seeing less activity than you would have seen sort of pre-recession. So we're going to dig a little more into that today. So how is that activity distributed? So in our publication that came out earlier this year, one of the ways we wanted to look at that is to ask, how have the levels of mortgage activities, in this case, we're looking at refinances, how has that changed sort of from pre-recession periods? And so if there's any growth at all, it's in the dark blue here. And so you can see in refinancing, there has been growth. The growth is exactly in the areas that, we identified as relatively high income. So a lot of what you see sort of post-recession is that high-income areas are actively refinancing. And then the darker red is actually a 89% or more reduction in refinancing activities. So those areas you're not seeing any sort of recovery. There's considerably lower refinancing activities. Now here's where the census tracts mattered some. So what I would have liked to have done for this is to show you change in census tracts from pre-recession 2006 to 2000, include some nice, some good years. Then I want to look at, sort of during the recession, and then I'd want to look at the very most recent data. And unfortunately, with the census tract definition change, I can't do that change because the geography has changed. But I'm going to actually, when we get to actual mortgage for a home purchase, I'm going to show you something that's as close as we can do to that. So you might be concerned, okay, well, banks are just rejecting out of hand lots and lots of lending applications. Well, that's not really the case. Kind of across the board, origination rates, so that's the conversion of a loan application into a actual loan, actually have stayed, relatively stable. I mean, in many ways, in many income levels. So, for example, a home purchase in a low-income neighborhood, we actually are seeing that the origination rates, once the application is made, the origination rates are actually higher today than they were pre-recession. So it's not really about origination. It's about sort of a general reluctance, or what we would see as a deficit in applications. Now, refinancing on the bottom is different. You see more rejections when you're thinking about refinancing than you see when you are looking at a home purchase. And, there's a little more, definitely more income unevenness in those rejection rates. But, again, I don't actually see anything about sort of the viability of that credit. So overall, I do want to say that, thinking about origination rates, and here I'm showing you sort of all of the years, there's a lot more steadiness in origination rates. So if you've got an application, those applications tend to go through in similar levels and, are actually somewhat up in many cases. So I want to focus a lot of attention on home purchases because home refinancing is one thing. Refinancing can certainly provide benefits to households and is one of the key aspects that housing can provide a community. But the actual purchase of the home is probably the most important step. So I want to think a little bit about how our home purchase loans faring across the sort of, again, high, middle, and low income areas. Right away, you can see that, at the start, a larger share of home purchase loans were in high and middle income communities. And, for people who've been in this world for a long time, that is not too surprising. That is what we have experienced. The impacts on low and moderate income community lending are certainly evident here. We see it coming down, and we see it, not entirely recovering when we go out to the 2016 data. So in our publication, we again do this calculation to say, okay, if I look at home purchase loans and I ask sort of, how do 2009 to 2011 loans compare to 2004 to 2006? So I'm asking, am I seeing the same level of lending activity in 2009 to 11 that I saw pre-recession? And not surprisingly, I mean, we've already shown you the aggregate data. The answer is no, we're not. But we want to think about sort of where is that happening. And I showed you refinancing. You could see that the better off suburban neighborhoods saw a lot of recovery in refinancing. There was a lot of that dark blue where you were actually getting positive numbers. Here, you really have to hunt. So there are a couple areas where there is blue, but kind of across the board, in home purchases, we are seeing a lower level of activity. That lower level of activity is kind of across our whole community. But again, you're going to see that the darker red area, the area that has the largest reduction, is some of our lower income communities. So the census tract boundaries do change, but I really did want to be able to compare sort of patterns pre and post recession across our, geography. So the census boundaries are going to change here, but the census boundaries don't change that much. It makes making that calculation of a change not feasible, not accurate. But I think you can see sort of what the pattern is. So here what we've done is we've calculated the number of home purchases per 1,000 of owner-occupied housing units. So that area that we saw as relatively low income does have lower levels of home purchase activity, even for owner-occupied housing as our regular features. So here I'm looking at 2004 to 2006. You can see that many areas in the Cleveland area have relatively low levels of purchase activities. Some of the suburban areas have similarly low purchase activities, but basically at this point we've taken the data, we've said what's high, middle, and low sort of activities. We've split it into 25% bins. So 25% of the census tracts are in the dark red, 25% are in the pink, 25%. So we're going to be able to look at this going across time to say, how have things developed? So going to the actual recession, not surprisingly, things pulled back a lot. So what was 25% of census tracts that were in the lowest level of activity of home mortgages per housing units, now as 54% are in that category. And in the highest category, the one that would have been the most active markets, and not surprisingly, things that were relatively growing, Solon, out on the fringes, you're going to have more of that. That contracts a lot, and so those areas end up being now only about 3% of census tracts are in that what would have been top quarter of activity levels. Even in that next step down, we're only talking about 7%. So 10% of census tracts have activity levels that were above what would have been the median pre-recession. So how about today? We have seen some recovery in activity levels in terms of home mortgages by units of housing. That dark blue area, there's more of those areas now. We're up to 5%. But that would have been a 25% slice of the data pre-recession. So even in those areas, we're not seeing as much activity. What was the weakest category, the dark pink or red color? That was a quarter of census tracts in pre-recession period. It's now 50% of census tracts. So I do want to emphasize that, yeah, we have seen in many ways a recovery in features of our housing market, features of where we're seeing lending activity, but it's certainly not complete. And many areas continue to see lower lending rates. And when we're working with Home Mortgage Disclosure Act, one of the first things you can and should ask is, how is this differentially affecting white and black households? So we do take a look at that as well. So both among low and moderate income borrowers and non-LMI borrowers. And I think, one of the things that, I find discouraging about this graph is that, I see partial recovery in both white and black households in terms of their, lending purchase loans. And that's not surprising given the aggregate data. But I do see less of a recovery in black householders, homeowners, or home purchasers in both LMI and non-LMI borrowers. So it's not a great picture. Since the Great Recession, homeowners in high-income neighborhoods certainly did take advantage of low interest rates to refinance their homes. That's that is a benefit to those homeowners. Home purchase loans made in LMI neighborhoods, along with many other suburban neighborhoods, have declined. There's really no question about that. The numbers of home purchase loans by black borrowers has seen little recovery. So we're not seeing the recovery that would be there. Now, in HMDA data, and any time that I have to talk about this, I need to recognize that, you know, in doing this, I don't and can't tell you about the individual characteristics of the loan. So I can't tell you about whether the bank should or shouldn't have made any given loan there, because I don't know all of the characteristics that the bank is considering. I did want to point to a couple other things, just because we've got some other great things that are going on in community development at the Federal Reserve Bank of Cleveland. One of my colleagues has done really nice work on Long Ride to Work, looking at where jobs are today versus where potential workers are today, and pointing out that it can often take you a long time to get to work. So you want to think about that. Another colleague has done work on, you know, actually trying to get evidence of mortgage discrimination. So in this case, they're using an email survey technique to evaluate whether banks are differentially treating people by the characteristics of their name. So names can sometimes indicate race. They use that to actually evaluate whether there's discrimination, and there are some differences that they find. And then finally, I did want to point out our HMDA reports. I talked a lot about the Cuyahoga County one. We've also completed Allegheny County. That's where Pittsburgh is, for those of you who want to reject anything Steelers. That is the right county. So it is a question that we can actually start to make some comparisons. We're working on Montgomery County, where Dayton is currently, and we're working on more counties as well, so that we can see sort of how exceptional the patterns are in Cuyahoga County. And all of that can be found at the last link, which is Community Development's webpage at the Federal Reserve Bank of Cleveland. So I know we're running a little behind, but I am happy to take a question or two.
Molly, you have I have a question. Sure. So the business about taking mortgages, applications. Yeah. So in addition to reporting data, you also regulate banks. And so the Federal Reserve Bank not only looks at this data, but then can compare it to individual behavior of individual banks. The struggle we've always had with a lot of lenders is taking applications, going out and actually marketing their products in the field. And one of the ways to kind of guarantee that you're going to get good loans is not take a lot of applications. Do you look at, you know, where they're taking their applications, their marketing, their outreach, how they approach the marketplace? I mean, it seems to me that if you're not taking applications, then you're doing a great disservice to some of those low and moderate income and African American neighborhoods.
Well, as you would know, I mean, one of the things that the HMDA data is involved in is when we're thinking about the ratings of banks and whether they are or aren't serving communities, and whether you know, branches should or shouldn't be in different neighborhoods. You know, that's one of the factors that gets included in it. But I think you're right. I mean, you do want to think about sort of how open am I to applications. And actually, the last paper here, does differential treatment translate to differential outcomes for minority borrowers, is looking at the application process as it, you know, is the focus, you know, as it typically is today. So typically today, if you're thinking about a borrower, they are going to actually look at an online ad. They're more likely to actually have an online transaction with a lender. And so what that paper is doing is to actually look at, you know, well, I'm going to send in emails that turn out to be not actually valid applications saying, hey, I'm interested in getting a loan. What sort of response do I get from banks? So from a research perspective, and I do come from the research rather than the regulation side of the bank, from a research perspective, we do think that there is a really important question there. It's something from a bank regulator side, you can or it's actually harder to evaluate than you think. But actually, I recommend this paper. It is a direct stab at trying to get that question answered about what do banks do when they get a sign of interest, and it's somebody who has an African American name or somebody who has a likely white name. Is there any differential in that treatment?
Good morning. I'm curious as to whether or not you can identify the reason why the rate for refinancing among low-income individuals was so low. Are you able to, did you guys identify that?
I can partially answer your question, although fundamentally I can't really identify it in the data. So one of the reasons why a low-income household, and I can see this in other data, so this is the reason why I can answer your question. I can't see this in the HMDA data. But a low-income household is likely to have less overall equity in their house. So if I want to refinance my house, I want to have lots of extra equity. Well, how do I have lots of extra equity? I'm an older homeowner. I've been paying for many years. So somebody who's in a lower income neighborhood is less likely to be an older homeowner who's been paying for many years. Not that there aren't some, not that that case does not occur. It's just less frequent in a lower income neighborhood. So, you know, sort of walking through the path, it's fundamentally about sort of how much equity do I have in the house. One of the other things that's going to matter there is how much price appreciation has there been. So refinances happen a lot when there's been a lot of price appreciation. If your neighborhood hasn't seen price appreciation, my options for refinancing are considerably more limited. So both there's the demographics of communities, and there's and by that I mean a lot of age and income and when did I buy the house, a lot of details that actually matter. And then there's fundamentally what's going on in the community in terms of home prices.
First, I want to thank you. The Federal Reserve Bank's data is always, you know, right on time, right on the money. But sometimes I think that we don't use it to the greatest degree, and what I mean by that is, having been in this space for a long time, the former director of a fair housing affirmative marketing organization myself, and I see the former head of the Cuyahoga Plan and CHIP, and we had Hillcrest Neighbors and on and on and on, is that there was a real push about 2 years ago to encourage African Americans toward home ownership. Now we have a push toward home ownership for lower moderate income, which is wonderful. I mean, that's the hat that I wear at the bank. But when it comes to these differences that we see, where it's so startling, the contrast, both in terms of the neighborhoods and in terms of the lending differences between lower moderate income blacks and whites, is there any way that this type of data could be used to encourage our foundation community to start funding some of those efforts again to help kind of eliminate some of those disparities?
Well, I'm very encouraged that you want to see this data. We think that this is important data to be showing and to be cognizant and straightforward about, this is what's actually happening in the lending environment around us. And I would encourage anybody who has a policy interest in sort of saying, hey, how can we help solve some of what we're seeing as disparities here, pursue that. Because these disparities, affect sort of ultimately wealth positions of households. So I very much, feel like this is something that, can and ought to motivate people to try to make things better.
Hi, so I'm wondering if you could go back to the screen that had, I think it was home improvement loans on the bottom. It was like a green line that went up a little bit and then totally down. Because my question, you just passed it. It looks like from 2008 on to 2016, and if that basically, the green, if that indicates home improvement, to me that means that either people are not able to get loans for home repair, or it looks like they just don't want to because they don't have the confidence in the market. So I'm just wondering if you have any comments on that, because to me that's a little troubling.
Yeah, so there is a category of loans called home improvement. If I'm a homeowner and I'm thinking about I need to, or I want to make an improvement to my house, I've got multiple options now. So the bankers in the room will tell you that in many ways now you're as likely to use various versions of a home equity line of credit as you would be to actually have a dedicated home improvement loan. And that sort of mixture is something that I can't sort of account for here. So I don't think that, I wouldn't treat this as a sign that home improvements are considerably lower than they were before, because there are other ways of funding that. And in fact, many, during the sort of 2004, some of those refinances went to money things. Some of those refinances went to home improvements too. So again, that's another alternative to actually how do I fund the home improvement that I want to make. So as much as I have that category there, I would not want to treat that as the only way in which households make home improvements.